afternoon, everyone, and welcome to Stock Market Today. It's Coram and Ed Carson here with the breakdown of today's action and a look at how the week unfolded. And Friday, some sharp losses across the board for the major indexes to cap off what was an ugly week.
Yeah, very ugly week, and in the context of several weeks of losses, not a whole lot of good, but we'll talk about that. Apple, Exxon, and General Dynamics do have earnings coming up. There's reasons why you should still be paying attention to these names.
Okay, well, we will get to that analysis, but first let's analyze the current market conditions by taking a look at the major indexes. So the NASDAQ today down 2.6%, the S&P 500 down almost 2.8%, same for the Dow, it's 2.8% plunge, the 900-point drop, the worst day since 2020, Ed, and the Russell 2000 down 2.4%, so a sharp turn lower after a big downside reversal in Thursday's session.
Yeah, really negative action. The NASDAQ undercut last week's low on Thursday. The S&P followed suit today, but the NASDAQ is one bad day. I mean, if we have this day again, especially since we fell a lot more than this, I mean, those last few minutes were really nasty. If we have one more day like this, we're undercutting those March lows. I mean, that's it. And so it was ugly action underneath, especially from Thursday's high. We were getting up to or getting past some key levels, and it was just been a pile driver ever since that time. Really negative action for the indexes, for leading stocks, for bad stocks, and there really aren't many safe havens. There's really just not many reasons to be taking part in this market right now.
Yeah, definitely a week to reduce exposure, perhaps even get almost all the way to the sidelines and at least only stay in stocks that are working and holding above key levels. But a lot of trimming, I think, happened, not just for Leaderboard, Swing Trader, my portfolio, I'm sure yours as well, Ed. So a week to act and take profits where you can and reduce that exposure. And just to kind of underscore the action into the close, let's take a look at an intraday chart of QQQ here. So as you can see, a sharp decline heading into the closing bell. And let's also take a look at the S&P 500 and see where it stands in relation to key levels. So just when we thought the S&P might get back above its 200-day line, some resistance there. And while it didn't undercut its recent lows on Thursday, it did so today in a big way.
Yeah, and we're seeing stocks, some of the sectors that were strong, and we'll look at a little bit, but some of the sectors that have been doing well, the miners and some hospitals, some of those medical names, and even some names that don't look as bad, they had some really heavy losses in the last couple of days. So the divided market is really becoming these little holdouts now, little pockets of places that are trying to hold out. And really, it's more of a relative thing. Now they're just holding up, a few pockets, right. But some of these sectors really coming under pressure.
And as you said, the NASDAQ one day away from maybe testing or undercutting its March lows, while the S&P 500 one bad day away from potentially closing below the low of its follow-through day, which is relatively significant.
Yeah, when you get below the closing, when you close below of the follow-through day, it's almost, a lot of research that it's almost always going to fail further and just completely go below the lows. It doesn't always happen, but it'd be a very strong sign. Obviously, the S&P and the NASDAQ looking weaker and weaker, and everything is looking weaker.
It is. Okay, so a quick run through of the Dow and the Russell here. The Dow was showing some relative outperformance with breaking above a trend line, getting above its 200-day, but that did not last long. So below key levels as well here. And taking a look at small caps, it looks like the close was very close to the close that it saw in mid-March. So right around where some of the indexes were making new lows or testing lows, so giving all of its gains back there. And now a look at the 10-year Treasury yield, because that's dominating the discussion here, Ed. There are fears or renewed fears, even though this is a known, the rate hikes, there's renewed fears, and that's impacting what we're seeing in the market this week.
Yeah, and so while today it may have dropped, but they're still so high. And the fact that it didn't drop more despite the market selling off like this tells you something. Yeah, we're going to have several 50 basis point hikes. Oh, unless they do some 75 basis point hikes, which is really getting up there. One Fed official says, well, I don't support a 75-point move in May, but that just sort of solidifies how aggressive, the fact that that's even on
Discussion.
the discussion.
Yeah.
So it's just so hard until that calms down, and that may be a while. It's just going to be
Mhm.
really difficult for this market.
Exactly. And, maybe there are some signs that fear is actually creeping back into the market and bearishness. But you also have to consider the fact that in this type of environment, it has been said that the Fed doesn't care about what the stock market does. The main goal is taming that inflation. It seems like at all costs at this point.
Yeah, I mean, if the economy is going to go into recession, and of course but they'll try to stop. And of course, it's very hard because any policy moves have an impact on the economy down the road.
Mhm.
But they are so worried about inflation now, maybe belatedly, and that's all. But they are not going to worry about the stock market unless if we're heading to the recession. So
Mhm.
that old protection that the Fed will save us, basically since at least 1998, that is no longer there.
Mm. Okay, well, now I'll look at some of the group action underneath the surface. One of the strongest groups this year, metals and mining, a big chink in the armor this week. So down 5% on Friday for the week, down over 11%, Ed. So that is a pretty bad sign when the leading groups now are starting to deteriorate.
And yeah, and there were so many names. I'm actually surprised it's above the 50-day line. There were so many that plunged through the 50-day line that I'm actually surprised it's not money. But yeah, it's these violent sell-offs. Some of the earnings. There was a lot of production updates. There were some earnings reports, all signaling, yeah, we're worried about the future in terms of production, about costs. So just a lot of things going on there. This you can't. It seems like, oh, okay, I can sleep on this. This is going to keep finding support at the 21-day line. Oh, that's fine. And then, boom, that is, this is one reason why you want to take some profits,
Right.
even with some of the stocks that have been doing well, because this is not, unfortunately, not that unusual, especially in the last few days.
That's right. If you had stocks that looked like this, hopefully keep an eye on that 21-day line support, profits into strength, close below the 21-day line, trim some more, and today continue to reduce, if not exit. But we'll have to see what next week brings, of course. But the overall picture much cloudier here. And a look at XLE energy stocks too took a hit this week, down 2.4% on Friday for the week, down 4.5%. So XLE here right at the 10-week line. So this seems like a pretty significant crossroads. Can this 10-week line contain XLE, and can energy stocks continue to lead even with this week's damage?
Yeah, and that'll be interesting with Exxon and Chevron coming up. We have China, I think the shutdown there is probably having an impact, on energy and commodity demand. That's probably in there. So this could be an area where this ends up being a buying opportunity, but we don't know right now. We
Right.
don't know. I think you probably want to wait for strength, especially with the market being as weak as it is.
Right. We like buying on pullbacks, but pullbacks that prove themselves, not just continue to slice through support levels. Okay. And just when we thought Jets, rather, the play here for the economic reopening and travel, just when we thought that was starting to get going, Friday, this area as well taking a hit, coming off by about 2%. For the week, though, up 2.8%. So in recent weeks, some positive reports coming out of a number of airline stocks. But even with all of that momentum, not immune to a market downdraft.
Yeah, and it became much more narrow because for a couple days ago, the travel sector was looking like this whole bevy of great opportunities. And yes, a few airlines did all right this week, but there was a lot of travel names, hotels, and so on that really came down hard. So, yeah, that's just no matter how good the news is, it seems like it's just not enough.
Okay, well, what about healthcare? Let's take a look at the XLV ETF. A huge drop here with, you have hospital names, medical product stocks, some key earnings reports that really dragged down the entire group, along
Yeah, the
with the
three
overall
worst.
market.
Yeah, absolutely. This was a just a really negative sign. And again, outlooks. We're seeing a lot of negative outlooks, and we're heading into the biggest week of earnings. I mean, when you have mining stocks and you have hospitals, and Intuitive Surgical, the worst stocks today were medicals. On the S&P 500. I mean, there's definitely some areas that are still doing okay, but wow. I mean, after so much, how many weeks did that wipe out? I mean, it's sort of like grinding higher. The relative strength line didn't fall much, but that's because the market is terrible.
Mhm,
That's sort of a recipe you can hear about a lot. Is that, but yeah, just
mhm.
really, really dramatic move.
Yes. So down 3.6% for Friday for the week, down by about 3.5%, all said and done. And last but not least, checking in on speculative growth through the ARKK, the highly valued stocks here, continuing their severe slump here. So ARK down by 1.6% on Friday for the week, down 11%. And it looks like it's very close to the lows from mid March, and definitely its lowest close going all the way back to the rally that was sparked right after the coronavirus crash.
Yeah, I mean, this looks terrible, but almost any growth name like Google and Nvidia undercut their recent lows. So there's a lot of misery to go around. And the thing is that you have to really look for areas that are even close to strong. It's not hard to find stocks and sectors that are selling off terribly.
Yeah, and we saw ARC up 18% in 1 week in March. And so for investors trying to buy hot stocks on the cheap, this is one of the dangers that comes with that.
Yeah, and in a bad market, so like if on Monday we rally 2%, I mean, what does that really mean? We've had a number of good days. We had a good day on Tuesday, and it didn't go anywhere. Ultimately, it was a very bad and discouraging week. I mean, for ARK and for everything else, that was a 4% gain on ARK, and
Right.
it's a blip. It's just a blip now.
Hmm.
So, that's so. If we have a good day, don't just leave it alone. I mean, I would say like in almost everything because it's you just have to see sustained strength, plenty of good days in bad markets,
Right.
and that's what we're facing right now.
Yes, we want to avoid that temptation. Don't focus on the leaders of the past, focus on current leaders. And even then, you still need to be agile, as this week has definitely shown us. Okay, well, let's take a look at some stocks here, Ed. Apple. Down 2.8% on Friday, undercutting recent lows. So it's now headed back towards its 200-day.
Now it's possible, and I'm actually trying to do the math. I think still technically in a very ugly fashion, you could say there's still a buy point at that 179, or some kind of other thing. But right now, look, it's through the 50-day line. It's heading to the 200-day line. The earnings are coming up. You should just stay away until at least earnings, until you're hopefully seeing a better market. But what's stunning is look how bad the last couple of weeks have been, and the relative strength line is barely dropping. So in a way, yes, if the market turns around, maybe Apple is one of those that it does. So you want to be interested, but it also right now is showing you how bad
Right.
the S&P 500 is. That you can have this sell-off in Apple, and it's really not underperforming the market. So pay
Hmm.
attention to this one, but for a better time.
Yes, and something that you've said that always has stuck with me, Ed, you can have a relative winner, but an absolute loser. And we don't want to be in losing stocks or holding losses. So we'll have to see. Maybe earnings is that catalyst, but only time will tell
Mhm.
if that can happen. But even if it does, that is not a guarantee that the stock will resume its uptrend. I mean, Tesla had a big gap up on its earnings report, and that faded by the close. So in this earnings season, we just have to stay on our toes. Okay, and we talked about oil stocks. So here's a look at oil major Exxon Mobil with its earnings report coming up in a week's time. Perhaps a handle being formed on this cut base ed.
Yeah, I mean, it had sort of been wedging up for the last few weeks. So in some ways, this was nice action. So you get a bit of a shakeout. I don't think you'd be shaking too many people out of this. So, but it's sort of coming down to the 21-day line, sort of coming down to the 10-week line. And on a weekly chart, it will have a handle after, give it a couple hours, let Market Smith digest today's action because it is down. And so there should be a handle that will show up there. And so, yeah, that's like a bit of a shakeout. This is one that's been really an impressive leader. It's been a leader in the energy group, which is saying something. I'd be interested not just for the earnings, but also what they say about capital spending, which will matter for a lot of other companies in the field. But yeah, really impressive relative strength. And now I just have to sort of see, can this stock, deliver with earnings in a week's time?
Yeah, that is a big question and something that we will be focused on come next week. And let's now take a look at a name in the defense sector, and that is General Dynamics, with some pretty tight action until this week, maybe a little less tight, but down 1.4% on Friday in light volume. Thursday's decline in light volume as well, but perhaps a little bit of a pause needed here as well. So pulling back 2% this week after 4 weeks of tight action, also with earnings due next week.
Yeah, and so defense stocks held up pretty well, just like energy names. There's a whole bunch of them have earnings this week. They all look the same, basically. All had this run up in late February on the Russia's Ukraine invasion. There's a lot of long-term reasons to be positive on defense spending here and abroad. So yeah, it came down to its 10-week line after trading fairly tightly, even this week down 2%. So you could imagine it does have a flat base buy point, rebounding from the 10-week line, maybe getting above this week's high. After earnings, that could be a buying opportunity. But again, you just have to really weigh it. What are your odds in this market? How much exposure do you want to have at all?
Yeah, so speaking of, as our wrap up and look ahead to next week, what should investors be thinking about as they do their weekend homework? It seems like now is the time for that minimal exposure.
Yeah, it's really, look, if you want to be in all cash, that's not a bad strategy. Okay, there's nothing wrong right now because the market is not acting well at all. If you should probably have at most minimal exposure in sectors that are still holding up. You want to take some profits in there, in those areas. If the only thing beyond minimal exposure is if you have long-term gains and long-term big winners. But yeah, it's just keeping it really, really light to nothing is the way to go until we get something there, because you want to preserve your capital and preserve your mental capital. I'm tired at the end of a week, but it's so much more tiring if I'm heavily invested and I'm losing. It's like, oh my goodness, this is some of the stress, and you don't want to be worn out and exhausted, before things get better. That's the worst thing. I mean, nobody goes out and does a 4-hour marathon, does a marathon before a marathon.
Right.
You want to be ready for that.
Yeah, let's stay fresh and ready for the good times whenever they do come. And if you aren't sick of Ed and I yet, we have one more video that we are doing today, but this one's a little different. So it's not going to be just a rehashing of the Stock Market Today video. Ed is going to share details on a personal trade that he made this week, and we may learn some fun stuff about him as well. This is our new weekly Stock Tales show, so that's coming up live on my YouTube channel at 5 p.m. Eastern. If you follow me on Twitter, I will be posting the link there, or you can go check out my YouTube page, youtube.com/Alissa Coram IBD. Ed, looking forward to having some stock tales with you.
That's right. I'm looking forward to it too.
All right. We'll see everyone then. Hope you have a great weekend. And we'll see you Monday morning on IBD Live, investors.com/IBD Live for all the details on that. Have a good one, everyone.